Kevin Giddis, is the bid slipping away on price in full faith and credit?
Well, Tom, we're finally starting to see this. A week ago, I would have said probably not, but we are starting to see this period closer and closer to the election, especially if we get this blue wave I talked about, because, I have these kind of nightmarish feelings of 2016 after the elections. If you're a bond guy, you did not expect the outcome and you did not expect the price action after the election. So I think the bond market and the treasury market in particular is underestimating the fact that if you got this blue wave or a complete sweep, what might occur after that and why interest rates are likely to go higher, not lower, should that occur. So, higher spending, more taxes, increased growth, and growth tends to have a friend. It's called inflation. And if all of those hit the mark, then yes, rate moves would be fairly significant, especially in the 10-year and 30-year out for the balance of the year.
So at 1 p.m. today, Tom Keene is going to be closely watching the 20-year auction of treasuries. I know he watches every auction very carefully. Is this a supply story in terms of higher yields going forward, or is it, as you said, a growth and inflation story?
Well, I think from a rate move, it would be a growth and inflation story. We really haven't had a problem selling our debt. And you guys have mentioned it earlier in the show about negative yields in particular. And you look across the globe, where are the opportunities? There still is a great opportunity in treasuries, especially in the long end of the market. But the door is starting to close. And the only way it does close is if we get a blue wave. If we get whatever they call a blue tide or whatever you want to call it, where you still Republicans control the Senate, and even if you got a Democrat or a Republican in the White House, the rates aren't going to move that much. I think we're going to be, we know what gridlock looks like. But if you get a kind of a clean sweep, I think the Treasury market would have to catch up fast, which was, higher rates across the board. But I don't think it hurts financing right now.
Kevin, you mentioned 2016, and it wasn't just the political event that was unexpected for many. It was the outcome of that political event that people missed, what the red wave would mean for markets. What do you think people are missing right now, Kevin? Be specific. We know the consensus. People think a blue wave increasingly, the probability is lifted over the last couple of months. What is it you think people are missing about what that means?
Yeah, the part that they're missing is the inflation part of the occurrence. 2016, if you remember, we went from a 180 10-year the day before the election to almost a 250 by the end of the year on the expectation of deregulation and tax cuts and growth. And that what was anticipated was that inflation component that really never came. We did see it when the GDP peaked in the first quarter of 2018, and then inflation reached its highest point in May of 2018. The point of this is now is they're not thinking about it in the ways that you would normally think about it, is that growth will bring that inflation at some point in time. It may not be in the next few months, but the bond market tends to try to get out in front of any uncertainty. And I think we're starting to see that now. I think we'll see it for the next few months through the election.
So, Kevin, how would you push this view through fixed income right now? Where's the misprice that you want to take advantage of?
It's, John, it's really still hard to find. But one of the things that are really going either way this goes, the tax-free muni market is likely going to gain. If the prospect of higher taxes is going to support that market, an uncertain or continued environment is probably going to support that market. We're still at 121% tax-free yields to the 10-year versus where we were at 75% in the pre-crisis period. So I still think that even though a lot of state, county, municipal credits are coming to market now, there is value in the muni market now, no matter who takes the White House and who actually owns the Congress.
Kevin, long ago and far away, we had a Monroe Trader where we could enjoy price declines. You and I have hallways of people that say the bond market never has a bear market. Can you model out a bear market to come, price down and yield up off of my Monroe Trader calculations?
I always said that when my Monroe Trader stopped working, it was the end of my career. So I still have a couple of them around.
Kevin, that's when you bought a Bloomberg. Thank you. And Mike thanks you this morning. Are we heading for a bear market in bonds?
So we have the potential for it, Tom, but really the only way we're going to see a bear market in bonds is if we see this big blue wave occur at election time, in my opinion. The rest of it looks like we will get increased stimulus at some point in time. We think that may be inflationary somewhere down the road. but we're still making up a lot of ground from what's happened during the pandemic, and we still have the pandemic to deal with. So I don't think it's extremely bearish unless we get this scenario play out in a blue wave after the election.
So the reflation trade that you're talking about, this idea of higher growth, has led a lot of people to feel safe or safer going into the riskiest bonds. And this morning I was looking at the spreads, the extra yields that investors demand to own the riskiest junk bonds over benchmark rates. It has contracted back to February levels. We are trading at about the average of last year. It is as if the pandemic did not happen. Is this market right that we are not going to necessarily get an escalating default cycle? Is that what this market is saying, or is it saying something else?
Well, Lisa, it's saying that, but I'm not sure it fully realizes that that may not occur. So I think, as you point out, I mean, we are almost to the pre-crisis spread levels, and certainly high grade in IG corporate debt, and almost there again on high yield in particular. And that's a sector I would be very, very careful with right now, because 290, 300 over the 10s for high yield is not enough of a cushion for me, based on where I think we're headed. So I think even so, let's say nothing happens or nothing changes, less than 300 for high yield is expensive purchase for a portfolio for me. I still would favor high, IG debt, but realize you're going to get it at less than 100 basis points. And you have to be happy with that. So even if we get higher yields, spreads would tend to contract even further, but you would get paid a higher yield versus where the Treasury is now. So I just think that it's an expensive opportunity to take on that additional risk in fixed income.
Kevin, you live and breathe this world. I just wonder, from the conversations you've been having over the last few months, do you sense there's a little bit too much confidence in credit because of the Fed backstop?
Yeah, there really is, John. I think that there's a point here where we're going to see a lot more bankruptcies, because they just have to occur, especially if you don't get stimulus within this calendar year. That is going to have an effect on credits themselves. But the offsetting opportunity, and you're seeing this a lot, even high yield companies, even the state of Illinois, are coming in and refinancing their debt at much lower yields, building cash positions, and they may see this. They may be able to ride the storm out without seeing as many bankruptcies as some are expecting.